Hello, in today's video we're going to be taking a look at the day trading GPS SPX daily key levels indicator, how to use it and how to utilize it in trading SPX 0DTE call and put options on the CBOE SPX index. Okay, so the way this indicator works is that every trading day at 9:30 a.m. Eastern New York time, the indicator, after analyzing pre-market action, will generate today's key levels. The most important key level is this here, the bull-bear key price level, which today is 65.0476. So what this represents is the main bull-bear pivot for this session. Bullish above this pivot and bearish below this pivot. This midpoint here and this midpoint here represent the standard stop loss levels depending on whether it is a bullish or bearish entry signal triggered by the bull-bear KPL. We'll also be referring to the bull-bear KPL as the BBKPL later on in this video. So for example, on a bullish entry signal triggered from the bull-bear key price level, your standard stop loss level is the first midpoint level below the BBKPL, which is mid BBKPL S1, which today is 64.9822. For a bearish entry signal triggered from the bull-bear key price level, your standard stop loss is the first midpoint level above the BBKPL, which would be mid BBKPL R1, which for today is 65.1131. There's also a tight stop loss level for those who wish to tighten up the risk profile and not use a standard stop loss, and they wish to use a tighter stop loss on entries. A tighter stop loss would be the first quarter level above the BBKPL for bearish entries, or the first quarter level below the BBKPL for bullish entries. So for today's session, since we had a bearish entry to begin with, we've gone ahead and drawn out the first quarter level above the BBKPL, which for today is 65.0803. We will be coming out very soon with an update to this indicator, which will include several new features, one of which would be the auto plotting of the tight stop losses, which are the quarter levels above and below. To do that in the meantime, you simply take the midpoint level and the bull-bear key price level, add it together and divide it by 2. And that would be the quarter level tight stop loss above. And for below, you simply do the same thing, taking this midpoint level, add it to this bull-bear KPL, divide by 2, and that would be the quarter level tight stop loss below for a bullish entry. Okay, so here we have the 9:30 a.m. opening candle for today's session. As you can see, we open below and close below the bull-bear key price level. So this is your bearish entry signal to enter a put option on the close of this candle. As far as a strike, typically the best strike to use is going to be an at-the-money strike. In this case, since the bull-bear KPL is 65.0476, SPX strikes are in 5-point increments, so the closest strike is the 65.05 strike. So buying a 65.05 put option, and as you can see here are the data boxes from that particular put option, and on the close of the candle the price is $12. So the entry price for the 65.05 put on candle close is $12. Typically, it's advisable to use the standard stop loss level on your entries as opposed to the tight stop loss level. Because of the tight stop loss level, there's more of a chance of getting stopped out. However, that's up to each individual trader and what their risk profile is. Okay, so as we mentioned before, if you prefer to use that tight stop loss level, here is that here. As you can see, in this particular session, neither one of these was breached. We had a move back up to the bull bear KPL and then a move back down. Then it shot up again to touch the bull bear KPL, shot back down, went up, came somewhat close to the tight SL but nowhere near the standard SL, and then dropped off all the way down to mid S1, S2 level. The mid S1, S2 level is considered 1.5 levels below the bull bear key price level. So with this indicator, your minimum target for your morning session entries taken off the bull bear key price level in either direction are going to be a 1.5 level move. The exception to that would be if we're experiencing extreme volatility. So if we're experiencing extreme volatility, then you would look at perhaps a 2.5 to a 4 level move. But we have not been experiencing high volatility for quite some time now. So usually in just normal and moderate volatility, what you're looking for in order to exit your trade as a minimum target is a 1.5 level move. And what is meant by that is 1.5 levels from the entry trigger level, which in this case is the bull bear KPL, to the minimum target exit level, which would be 1.5 levels, which is the mid S1, S2 level. So for example, the S2 level would be a 2-level move. So you don't necessarily have to get out at this 1.5 level move. However, at this 1.5 level move, if you're not going to close out 100%, then it is advisable to adjust your stop loss on your trade so that you will have a profit if in fact it comes back up and retraces. So what that would mean in this case is you would adjust your stop loss all the way down to the mid baby KPL S1 level, or if you'd prefer not to do it by levels and just by price, then since we paid $12 for this, and at this point when it hits this level here, the put option had risen all the way up to 22.21 on this close here, and then later on here in these candles again where it does hit and break through the mid S1, S2 level, it got as high as 24.50 and a close of 23.49. So if you were adjusting your stop loss here by price instead of level, because you were not exiting here and you chose not to exit at the minimum target level, then you would want to at least make the stop loss at least a 25% profit. So in this case, a 25% profit on 12, 25% of 12 is 15, so you would adjust your stop loss to 15, which in this case, had you not gotten out here, then you would have gotten stopped out here on this level here if you had adjusted your stop loss, or you would have gotten stopped out when it retraced back to 15, somewhere in this vicinity here. But just keep in mind that in most cases it's prudent to start closing out 100% either at the 1.5 level, which is the minimum target, or a 2-level move. If you're trading multiple contracts instead of single contracts, and what I mean by multiple contracts is trading 4 or more contracts, then your alternative here to closing out 100% is that you can close out somewhere between 70 to 90% of your contracts and then adjust your stop on the remaining runners. So what that would mean as an example, if you were trading 4 contracts, selling 3 of them here and closing out 3 of them and leaving 1 as a runner. So you're closing out 3 of them here on this close of 22.21 on the close of this candle here, where it comes down and touches the mid S1, S2 level. If you want to leave a runner instead of closing out on 4, you would close 3, you leave 1 runner, and then you adjust the stop loss on that 1 runner. If you were, for example, trading 5 contracts, then selling 4 of them would be 80%, and again, you're leaving 1 runner. If, for example, you had 10 contracts, then the 70 to 90% rule would mean that you'd be closing out at least 7 or as much as 9 of those 10 contracts, leaving the rest as runners and adjusting the stop loss on the runners. As you can see in today's session, any runners that you had left would have gotten stopped out, which that does happen, but it's impossible to tell on any given day what exactly is going to happen, especially in the current political environment we have at the moment, where news can come out at any time that affects the markets. You just don't really know what exactly is going to happen. So, where you can get a spike in the market in either direction based on some form of news coming out by either some interaction with the presidency and the Fed, or by some other news event coming out regarding the economy or tariffs. Okay, so in this case, you're closed out or you've left runners and adjusted your stop. You have a nice profit on the day. We had an entry of 12. We're out at 22.21. That's on this candle here. If you didn't get out on this candle, then you also had this candle here, and this candle here. So basically you had about an 8 to 10 minute window if you failed to get out here, or you could have gotten out here or here or here. If you did get out later here, then you were getting a somewhat better price on the close of 23.49, and you had an opportunity to get out at a higher high of 24.50. Okay, so another thing to keep in mind with this indicator is that at the start of the session, your entries are going to be entries from the bull-bear key price level. So they're either going to be bullish entries or bearish entries triggered off of this bull-bear key price level. So the majority of your entries on a day-to-day basis, starting off in the morning, which is going to set the tone for the rest of the day of whether you're going to have a profitable day or not, are coming from entries triggered from the bull-bear key price level. However, the point I'm trying to make is that these levels have a dual use. So the levels above and below are dual use. The primary use of them for the morning session is for take profit levels on entries triggered off the bull-bear key price level. So take profit levels above would be for bullish entries triggered from this level, and take the levels below or take profit levels for bearish entries triggered from this level. However, later on in the session, these levels can also serve a purpose of entries for additional plays should you wish to engage in additional plays during the rest of the session. What you're looking for there is price action and how price action is reacting to these different levels. So as an example here, we were already out of this trade here. Once you saw this price action here of this rise above the S1, another test here, and then we have this here, which is a higher event occurring here. You could have entered into a long trade here. Now once you get into this part of the session, you have a few more options as far as what type of strikes you want to use. So at this point, you could either use an at-the-money strike of the S1, 64.91.67, so that would be a 64.90 call on a bullish play, and your stop loss would be the first midpoint level below, which would be mid S1, S2. If you did a tight stop loss level, then it'd be the first quarter level below S1, which again, as I pointed out, you just take the mid S1, S2 level, add it to the S1 level, divide it by 2 if you prefer to use the tight stop loss level. However, in most cases, it's best to use the standard stop loss level. And as I pointed out earlier, we will be coming out with an update that will have several new features for this indicator, and one of those features will be the quarter levels above and below each main level, and it will auto plot those, and you can simply select which ones you want to turn on. If you purchase the indicator now, you will be able to get the indicator at today's price, which will be less than the price when the update comes out, and then you will also be entitled to get the update at no additional charge when it comes out with those quarter level features, as well as a few other features that will be enhancing this indicator. Okay, so getting back to the point I was making about strikes, so you could either do a 64.90 call, you could also do a 6,500 call based on this, and that would be an out of the money call based on this mid BB KPLS1, one level above. It's a 6,500 call is the closest strike to that. Or you could go even further out of the money and do a 6505 call, which would be based on being the closest strike to this bull bear key price level. Just keep in mind that at the money is going to be more expensive than out of the money. So even though the out of the money ones, so the pros of that is they cost less money. The cons of that is price has to move that much further over a shorter period of time in order for you to make a profit. On the other hand, if you have an out of the money call, you have less money total at risk, even with your stop loss in play. So you're putting out less money to buy the out of the money calls, so in total you have less money on and risk as a whole. That's up to each individual trader. So just getting back to the rest of the session here, as you can see in this case, if you'd entered here and you had your standard stop loss here, or even if you did use the tight stop loss, it was not breached again, and we did get a nice move back up beyond the BBKPL. Okay, one thing to keep in mind too is Lotto plays at the last couple of hours of the session. So the Lotto window starts at 2 p.m. and runs till the 4 p.m. close. Generally, you want to enter any Lotto plays before 3:40 to 3:45 p.m. hits. The reason for that is that you would like to leave enough time for the most chances for a spike in either direction. So depending on which direction that you're picking on your lotto, if you're picking a call lotto, obviously you're looking for a spike in the up direction, and if you have a put lotto option, you're looking for a spike in the down direction. So entering before 3:45 still gives you 15 minutes, which typically with SPX there is some wild price action during the last 15 minutes. Not every day, but on quite a few days. And today was one of those days where it did happen. The general lotto play rule is only use up to 10% of session net profits on any lotto play you're considering entering. So for example, if you have, in this case, $1,000 of profit from trading one contract, buying at 12, and getting out at 22, 21 here. That means that you could take up to $100 as your bank for a possible lotto play. The reason that you want to cap it at 10% is that on lotto plays there is a very good chance that they will go to zero or you will lose money on them. That's why they're lotto plays. So there's a chance that they could go 5x, 10x, 20x, or even more. In some cases, we've seen lotto plays that have gone as high as 50x or 60x on certain days. But you just have to be prepared that there is a good chance that you will lose that. So if you do end up losing it, you still have 90% of your profits that you earned earlier in the session. Okay, so as far as determining when to enter during the 2 p.m. to 4 p.m. session, as far as the lotto window, generally it's going to be better to enter it later on in the session, even though the window for lotto plays starts at 2 o'clock and runs for 2 hours into 4. It's really just the context of what's going on in this session. But I would say on an average day, you're really better off waiting till after 3 p.m. To start really seriously considering lotto plays. And then, as time moves down, as we said, the cutoff would be 3:45. So if you want to look at it that way, your sweet spot area would be 3 o'clock to 3:45, even though the window's from 2 to 4. One reason is because the prices are going to be a lot cheaper at that time, and that's what you're really looking for. You're looking for cheaper options that still have a chance of making pretty good money should we get a spike in the direction that you're playing. Okay, so here is an example here from today. This candle right here is the 3:14 candle. This is the 3:12 candle. This is the 3:16 candle. So during this 3:12 to 3:16 window, which actually is comprised of, when you think of this is a 2-minute chart, the 3:16 candle ends at 3:18. So this is basically a 6-minute window starting at 3:12 p.m. where you can see how this comes down, it's going back up, it's coming back up. We just had this breach here, and then that was it. There was no more closing breaches, and we have basically the same type of pattern here. So here, even though you could have picked a down play and a put play, and that's completely up to you. So these lotto plays, even though you're trying to make the best decision based on what's going on, they're really coin flips when it comes right down to it. But they do have the possibility of making an extreme return on them should they hit. So in this case here, more inclined to take a bullish play, one, because it is above the bull bear key price level and it's been holding above it for quite some time. During this window here, we have the 3 data windows here. As you can see, we had a close, we had a low intercandle of 30 cents on all 3 of these. We have a high in one candle of 50 cents, a high of 40 cents in the other one, and a high of 55 cents. The close of the candles was anywhere from 35 cents, 37 cents to 50 cents. So you could have gotten in somewhere between 30 cents and 55 cents over this period. So let's say, as an example, that you got 2 call options for 50 cents each at $100. That would represent 10% of your session net profits earlier, because we had slightly over $1,000. We had $1,021. Okay, so you have $100 in. At this point here, again, if you do want to use a stop loss, you would either use the quarter level below, the bull bear KPL, or this midpoint level below for standard stop loss. However, on Lotto plays, if you only have $100 in it, you might be better off just having no stop loss and just letting the $100 ride, as we talked about earlier. That you have to be prepared to be able to lose whatever you're putting in, which is why you're capping it at 10%. If you do want to use a stop loss, you still use the same methodology. However, on Lotto plays, that's really up to you. There's also, a lot of validity in not using a stop loss, especially if you're buying them that cheap. Okay, so as you can see here, we did get a move up. These slightly increased in price, and then we had a move back down, and then we had the spike up at the end of the day. So on this candle here at 3:54 p.m., it opened at $1. It made a high of $4.50. It had a low of 65 cents, and it closed at $3.80. So again, this is a 2-minute candle. So with Lotto plays, what you want to do is as soon as you enter the Lotto play and you've confirmed that your order was filled, you immediately want to set your take profit. So you would send in another order that you want to sell. So you bought the options you bought 265.15. Excuse me, I forgot to mention the strike. And the reason why we're picking the 65.15s is, one, because of the price. When you're looking at the option table for the different strikes, you're looking for something that is somewhere between 25 cents and $1. Okay, so you could have taken a strike that was less out of the money and paid closer to $1 for that. The reason for that here is you have this R1 level of 65.1785. And this is an end of the day play, so we're looking at, even though 65.20 would be the closer strike to this technically, because this is slightly over 65.1750, it's between 65.15 and 65.20, but you're just trying to err on the side of caution here by taking the lower strike, and because it's already so cheap. So 65.15 and from 30 to 55 cents, you're getting 2 for 50 cents. It does spike up right to that level at the end of the day. So going back to the point I was making, whether you want to put in a price of $2, $1.50, whether if you're okay with just getting 3 times and getting $1.50, then you put in your sell order to sell your lotto options at a limit of $1.50. If you want to see if you can get, 8 times, then you can put it in at $4. If you want to see if you can get 6 times, you put it in at $3. If you're trading a lot more than just 2, let's say that you've been trading 5 or 6 options here, and instead of $1,000 profit, you had a $5,000 profit, so you had $500 to work with, and you were paying 50 cents, and you had 10. Then a prudent thing to do is to stagger your sell prices. So sell some at, say, $1, $1.50, $2, $2.50, $3, $3.50, $4, etc. So you stagger them in whatever amount that you want, so that you're getting triggered as it makes its move up, and you're more likely to get filled on everything. Okay, so another thing I'd like to point out is that if you are interested in purchasing this indicator, like I said, we are going to come out with an update to this indicator probably within a couple of weeks. At that time, when there is an update that is going to have several new features added to it, the price will be going up. However, if you buy now, you will be entitled to get that update for no additional charge. And we also, if you will email us at daytradinggps@gmail.com and request a promo code for the SPX Daily Key Levels Indicator, we will send you a promo code that will give you a substantial discount off of the current price, which will enable you to get in at a much better price now, and then you'll also be entitled to also get the update when that comes out at no additional charge. All of our indicators are sold on a lifetime access basis, so you make one payment and then you have lifetime access to the indicator. Lifetime access means that as we make new improvements to that indicator and come out with new features in the future, that you are also entitled to get those at no additional charge because you have lifetime access. However, just keep in mind that as we do add additional features in the future, the prices will be increasing. So it's best to get the indicator now, get the lifetime access, especially getting a discount with the promo code by emailing us at daytradinggps@gmail.com and requesting the promo code, and then you will get all the updates as in the future with any additional features at no additional charge. Okay, so thank you for taking the time to watch this video. If you have any questions, you can also either leave comments in the video description below, or you can email us at daytradinggps@gmail.com. So thank you again for watching the video, and we wish you much prosperity in all your future trading endeavors. Thank you.